So any questions people have, again, put it in the Q&A, and I think we're going to be a little jam-packed today, but still I'd love to get questions from you guys rather than just rattle on.
Indeed, indeed. Okay, so let's get started.
Hey, David, I do have a housekeeping question, David.
Yes, go ahead.
Someone just reached out yesterday, I think it was, asking where they can find this series or a prior episode. There was something mentioned or a speaker, and they wanted to go back and look at it, and I don't remember where the location is. So how do people find this on your site?
Yep, that's a really good question. We're actually currently sorting out a new YouTube channel, and so we will be loading all the weekly webinars onto the YouTube channel. So as soon as that is open to everybody, we'll make that known. Maybe even as close as next week's webinar, we'll be able to give the details of that, which will be good. So it's definitely coming in the next couple of weeks. We've got lots of content to load up, which I think will be informative to people, and it means they can dig back into what's relevant to them. I think one of the good things about this type of a weekly webinar is that not everyone necessarily needs to hear every single webinar potentially. But where a topic is relevant to them, they can go back into the library and access that topic, which is good. So okay, so let's get on with this. Welcome everyone officially once again to our weekly webinar, Lessons in the Lockdown. John Corey from Property Fortress runs his monthly networking meet there and has a successful consultancy business. And myself, David Johnson, MD of LEOpropcrowd. We are a property crowdfunding platform, and we host this every week. Fast moving, 30-35 minutes. John hates me mentioning time, but I'll still throw that in there just to sort of let you know it's not going to be an hour and 10 minutes. You can block us out of your diary, tune into it, and get the latest update on what's going on. Today we're joined by Chris. You can see him on the slide there. We'll do a formal introduction in a few minutes, but you can say a quick hello now, Chris, if you want.
Hi, everyone.
So, again, just always, I know it's a frequent slide, but still is relevant to mention those in NHS, essential services, who continue to have their lives put on hold effectively with this COVID-19, which is still ongoing. I think current affairs and what's happening in the world has perhaps taken the attention away from it, but there are still countries that are affected, and as our own lockdown sort of gets relaxed, it will be interesting to see if there is any effect on infection. So we'll keep an eye on to that. So agenda today, property market update, one tip for success, and then we're going straight in to have a really good conversation with Chris Cleghorn, and that's going to be very interesting and very, very valuable. So in terms of market update, hot off the press yesterday, this was literally just announced yesterday, that Nationwide are actually reducing their LTV on their products they offer. This will have a little bit of an effect on the market, and I know, John, this is the sort of thing that you like to keep your eye on because you can kind of bring your experience and the different factors that there are when it comes to this. So I'll let you make the comments first of all.
Well, I want people not to overinterpret this. So it's going to impact the newer buyers or the buyers with limited deposits. You know, if you only had to put 5% down versus 15%. At the same time, as taxpayers, I don't want to see a lot of people putting 5% down because I don't want to have to bail out a bank again because they lent money to people that couldn't keep up payments. If you can't scrape together more than 5%, what does that mean about your sustainability? Now, the other side that most people won't recognize is because of 2008 and the laws that changed after that, regulations in banking, the lenders are, especially ones that can take deposits like Nationwide, have much stricter capitalization requirements. And they're not allowed to make high LTV loans in a large volume. They need to keep it down closer to, I think it's 15% of their loan book and no more. So one of the ways that they can do that is obviously is to change the LTV. If they don't manage that well, then they're going to get slapped by the regulator. They're going to have to put up more capital, and they do have to monitor their loan book. So if they were making 95% loans and there's a 5% market correction, suddenly now they're going to be in breach of their requirements or could be in breach, and it would be a rather negative experience. So I think this is a prudent move on two levels. One, as a taxpayer, I'm not sure that we should be lending money to people who can't scrape together more than 5%. And second, when it comes to bank regulation, we want the nationwide to stay healthy. We don't want them to be in the ICU or the A&E because they've got too many high LTV loans. So I think there's a few ways to look at this. I would not look at this as it's an indication of the value of the housing market, and what they're not predicting the housing market, they're just protecting their loan book.
Yeah, I think that's a good way of putting it. It's not necessarily that they're indicating that they expect the market to fall to levels that would cause them problems. They just have to be prudent in terms of their own business strategy and their own business operation to allow for that possibility that may happen. I mean, I sometimes think that the whole property market, John, is a little bit of swings and roundabouts in the sense that sometimes even bad news isn't necessarily all bad in the sense that, yeah, the property market might fall. For sure, that is not good news for landlords who own portfolios. Might be good if when the market's high, then the rental demand is higher, which people forget sometimes. But if the market does fall a bit, it does also allow some first-time buyers to get into the market that maybe currently are excluded. And for the overall economy, that's not necessarily a bad thing.
I don't think they're excluded. I think they should just save more. So,
I knew you would find that controversial. Well, we'll not pick any more at that one today. That's something we can keep an eye on in terms of how that does play out. One thing we'll do next week, it was just come to my mind, is that just literally this morning I received notification that the FCA have published a consultation paper regarding mini bonds and preference shares. This is regarding the regulations they put in place in Q4 of last year, and they're now looking to possibly make them permanent. So perhaps next week, John, we'll maybe focus on that as a market update and have a...
Yeah, we could definitely focus next week if you like. Two quick comments. One is I actually read the temporary ban, and it's their full intent to make the temporary ban permanent. So they would just continue after December with what we currently have. And second of all, for everybody that doesn't understand the details, it's not always the easiest. Mini bonds aren't really defined legally, but what is defined is a debenture, a loan. And the temporary ban in the consultation applies to all loans. And they're particularly targeting property developers or people who buy property to improve it, to then sell it, among other business types or strategies. So people should take a look at the consultation and be part of the conversation next week.
Brilliant. Okay, so the tip for success I wanted to mention this week, and it's very relevant to our guest today. And I spoke to Chris on Saturday with a conversation, and I really enjoyed that because it was almost like looking in the mirror a little bit from where I was 20 years ago, and we started at the same place. Chris went a different journey, staying involved in buy-to-let. My journeys went a different direction, but it was a very interesting conversation. And one thing that I've always been very conscious of in property is the importance of strategy. And I've often used the phrase that people talk about, the most important thing in property is location, location, location. And I often say that isn't the case when it comes to property investment. For me, the most important thing is strategy, 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 because that's the most relevant starting point. Now, I've put a couple of quotes and I just pulled off so-called gurus in the market last night. And I want, if possible, let's get some participation. So in the Q&A, I want people to confirm if they agree or disagree with these two statements. So the first one is, smart property investors choose capital growth over cash flow. And the second statement is, successful investors look for locations that have proven track record of capital growth, which will outperform over the longer term because of their demographics. So two statements from so-called gurus that are saying that capital growth is effectively fundamental to property investment purchases. So if people could go on the Q&A for us and just give us your opinion on whether you think this is, whether you agree with those two statements or disagree.
So you want them to just say agree or disagree, or do you
agree
want
or
them
disagree?
to?
Yep,
Okay.
just as simple as agree or disagree. Let's see who's willing to put their head above the parapet. And I suppose if you don't know, then just write don't know. There's always the ones that don't know. Agree. Cash is king. We should stuck to that. Disagree. Okay, so let's see. Just give another 4 or 5 seconds if anyone else wants to. Okay, so keep throwing in another agree. Okay, interesting. Disagree. Oh, interesting. So as I expected, we've got a
1 second, David.
Yeah.
For just to repeat, do not use the chat. Use the Q&A. It's a different button.
Oh, was there ones in the chat I didn't see?
Yeah,
those?
there's a couple, 3 in the chat, which it's not a problem, folks, but just it's easier for us to manage the questions that are open versus the ones we've already processed in a sense.
Okay, very interesting. So agrees and disagrees are mixed, which is yeah, interesting. Okay, so for me personally, it's a disagree, because there are other factors than just capital growth in certain strategies. So to me, the answer can be both, and the answer is only dependent on what is your strategy. Hence, I'm making the point with the sledgehammer that the starting point to me of property investment and being a property professional is you have to set your strategy first. I think that'll become clear when we move on to Chris. So, John, any comments on that before we bring Chris in?
No, I'm good. I think we can, in a sense, develop this after Chris shares what he has to say.
Yeah. Okay. So, as I said, my personal view was disagree, but let's move on to bring Chris in, and as John says, we'll discuss this as we go along. So, special guest today, Mr. Chris Cleghorn, buy-to-let specialist. You can see there that Chris has actually built his own portfolio to about a 14 million value. Now, I'm sure you'll not mind me saying there obviously is some bank lending on that, but it's obviously only a limited proportion. And obviously, he's built an incredible business for himself. But interestingly, the quote I put up there, which is on his LinkedIn, single lets are my only property strategy. So I'm totally focused on what I do well and enjoy. So that is an interesting comment, Chris, and one that I'm easily resonated with. But I'll hand over to you just to say a quick hello and just give a bit of your background, how you get into property, and we'll go from there.
Yeah, thanks, David. Morning, everyone. Over 20 years experience, but I want to add that that started off on an unplanned basis. It was fairly accidental. My grandmother died, left me a little money. We bought our first house from that because it was kind of flavor of the month at the time. It went on from there, and then we began to take it semi-seriously and then extremely seriously. And it's evolved to a full-time business for myself, my family, but also for my clients that we build these portfolios for, under the same roof as we're doing all of the work for my own properties. If I can start by just going back to David's question about capital growth or cash flow. I've got a fundamental issue with the argument for doing it for capital growth reasons. And that comes down to the fact, in my view, that's speculative. And it could end up where there are factors outside of your control that will damage capital growth or even end up putting you into negative equity if that's the primary drive for your strategy. If the cash flow is right, then over long term, capital growth should take care of itself. So I think this is the point David's making. There's a strategy in there, and before you buy your first property, you really want to know exactly what direction you're going to take. A lot of it's geographic. London for sure, yields aren't great. Capital growth can be. The Northeast where I'm based, capital growth isn't great, but cash flow, if it's done correctly, is wonderful. So I preferred to use the cash flow model because everything we own, we're holding for the long term. So therefore cash flow is absolutely vital. That's built itself up quite nicely to over 100 properties. But I think if David and John don't mind, I'll throw in, it kind of makes where I'm coming from in a moment more relative, in that back in the last banking crisis, I was doing some development work alongside my buy-to-let business. And in the space of 10 days, when the financial crisis kicked in, I lost the thick end of £1.8 million on developments. So you can probably guess why I'm not a fan of the speculative side, and I prefer the consistency of monthly cash flow. So that's kind of created my mindset to be self-protective and extremely risk-averse. And it's possibly why I've ended up choosing to stay absolutely focused on what I know best and what produces, which is buy-to-let.
Yeah. So what you're saying is it wasn't that you started out from scratch and decided on this strategy. You were in the market, you were doing a variety of strategies, buy-to-let, development. The 08 happened, the crash, the pain that came with that. And that's what forced you to say, okay, this is my niche, this is my strategy, this is what I'm focusing on.
Correct. And my love for buy-to-lets, David, has really been enhanced because I actually funded paying back that 1.8 million from the cash flow from my rental portfolio.
Very good.
So,
very good.
This is why I call them my beloved buy-to-lets. I know that's a bit wussy and a bit dramatic, but for obvious reasons, I'm very affectionate towards seeing this thing done properly.
I think the other side of this, so the complementary activity, is it's the fourth bullet point, that not only have you built your own portfolio, which I think is 100 properties, but you've done approximately 700 transactions where you've spent a lot of your time helping other people acquire properties in your target market.
Yeah, absolutely, John. It just goes hand in glove with what we do day to day. So it creates extra revenue from us, to be fair, because it's the same team that are working on a client's properties that work on my properties. So there's capacity, so why not?
Yep. Okay. So I'm going to jump to this slide first to explain the Northeast, and then we'll go back to slide and use your example slide. So,
David, you broke up there. What did you just say?
Okay. So we've jumped one slide, Chris. So we're going to do this slide first to explain the Northeast, and then we'll go back and do your example of a transaction that you've done.
Yeah, I've asked to put this slide up, David, just primarily to try and demonstrate from a geographic point of view where we operate. If you kind of drew a triangle between Newcastle, Durham, and Sunderland, that's it. We don't go outside of that because we don't know it, we don't understand it. We know this area intimately, the good streets, the bad streets. We know where to go and where to stay away from. So again, it's just being risk averse. We know these streets, so we know how they perform. We know how rent is paid. With the social issues, antisocial issues, etc., etc. So I just wanted to demonstrate on there that it's a very minute area, really. When you look at it in a scale of the whole of the UK.
Yeah. And was that decision to operate in this area exclusively, Chris, only because that's where you're from, or you identified this as what will suit your strategy?
Both, David. It's where I'm from. But if we look at property pricing and rental demand and rental levels in that geography, for me, it's almost a mix of the perfect storm conditions to make buy-to-let work extremely well and extremely consistently.
Brilliant. Okay, so take us through sort of quite quickly the numbers of what would be a pretty average deal. I'll just point out at the bottom there, we've had to add that to the slide, Chris, obviously from a compliant point of view. Past performance is not a guarantee of future results. So just to keep that right. But yeah, so
David, why don't you repeat that, because it's actually not on the slide I can see.
Is it on the slide, Chris, you can see?
Yeah, I've got it, John. I can see it, yeah.
Must be cut off. I'll have to maybe So just repeat it in case other people have got the bigger. I know what it is. When you shared, it made the slide big, so it's below what I'm seeing.
Okay.
So,
okay. So yeah, if anyone can't see it, just down at the bottom beside Chris's logo, we've had to add in a past performance is not a guarantee of future results, and that's just for financial promotions purposes, that people understand that this is an example, and that neither Chris or myself is saying that, you know, if you do this, then you're guaranteed to have the same sort of figures and return on capital that Chris is showing you. So just to put that disclaimer up. So, okay, go ahead, Chris, give us a quick run through of what I assume is a standard transaction for you.
It is. We could put more glamorous properties up. We could put less glamorous properties up, but I've tried to pick something that's everyday, middle of the road, David. That's a real deal that we did. It's not a fictitious one. And you know, we've put the headline figures in there. There are lots of other drop-down lines underneath that, you know, where the costs come from and how various things are worked out. But given the time constraints of today, we've tried to bullet point this. So there was a RICS valuation done of that at 55K. Distressed vendor, we got it for 45, clearly creating a day one equity of 10K, which is very nice. Thank you very much. The rental income side on that is typical, and an interesting point on there that a lot of my portfolio, we rent to people, normally families, normally single parent type families. They're less prone to move in and out of properties. You know, they want to put down roots, kids in school, and so on and so forth. So it's important, but 90% of that rent, the rent of 475 per calendar month, although this particular tenant works 16 hours a week, she claims a form of income support benefit, which gives her some assistance with her housing costs. So there's a big chunk of that comes to us directly every month. So the chance of any serious default or arrears is minimized. And that's part of my strategy. You know, we've got over 80%, 82% of my properties are on this basis. That's not by accident. That's absolutely by choice. And we love that demographic. We love that type of tenant. So the drop-down numbers is giving a gross yield of 12%, net yield after costs of 6.7, which in anyone's book I think is fairly healthy. But the point that I always want to try and get across, we'll talk about training courses in a moment, I'm sure, but for me, that there is real yield and theoretical yield. And there are a lot of people out there that look at properties on Rightmove, for example, and what they're trained to do or what they see is let's find the cheapest possible property. They'll research that, and then they'll do a bit of research on the rent and think, bingo, they've cracked it. A great deal. But they're not really looking deep enough into the type of tenant, how the rent is paid, what's the source of those funds, what happens if unemployment kicks in. There are so many other little things that come down, and this is a real driver on our part to consider this as part of the strategy to protect cash flow. So there's a circle completing within the thinking behind the strategy. Return on capital 34.6, again fairly healthy. But this is a typical Northeast property that we get involved with and looks very similar to many of the ones that I own personally.
So this is return on capital employed or left in or invested.
Correct.
And so it stayed in it. And there's almost a 50% haircut between gross yield and net yield. Any insight on that, Chris, for people who think, they focus on gross, they don't realize how expensive these are to run?
Well, this again is a training course issue, John. They're glorified and they're looking at gross yield at 12.6. You've got to consider management costs. You've got to consider a maintenance budget. You've got to consider a mortgage payment. There are lots of things that if we were giving you the full sheet of this, which we can't really do today for time or space reasons, there are probably 20 or 30 lines underneath all of this that confirm every single penny of expenditure. And that's why we arrive at the net of 6.7. So again, the costs are absolutely vital to the overall cash flowing and receipts against this particular property.
Okay.
Just one point of clarification. Someone's asked in the Q&A there. So in this particular example, there was no renovation or decorating or anything like that.
No.
You're able just to buy it and move a tenant in.
Yes, and again, that's part of strategy, David. You know, I'm aware of buy, refurbish, refinance type models that are fairly common. We try to stay away from those. We get a sufficient supply of properties that are in good condition. They may need a light refurb, a lick of paint, a lounge carpet, or a kitchen sink. We prefer not to go for properties that need 6-8 weeks worth of labor and cost going into it. We try and find them where we can turn them around quickly. And I think from this one, from the day of completion, 5 days later, the tenant was moving in. So it's cash flowing quickly.
Okay, that leads me on to another question that I'm curious to ask, because I don't know the answer to this. So you've obviously got a very impressive portfolio, 14 million value. That's a lot of properties. Management, is that done all in-house, or do you subcontract that? And secondly, give me an idea of the size of your team. If you're moving that quickly and dealing with that many properties, I'm guessing it's not just you. You must have a team around you. And how does that look?
Yeah, I certainly do. There's a team of 7, no, there's no contracting out. This is done under our roof. We manage them. We're accountable to ourselves. We manage them in a certain way. Not knocking the lettings business industry at all, but I don't believe they are motivated correctly to do a proper job in full-time management. If you look at this one,
there might be a couple of attendees on here now that may disagree with you, but that's another matter.
Actually, in a different way, Chris, do you offer your letting services to any outside investors who have property in your catchment?
If they're a client of mine, John, and we're building a portfolio, we would insist on managing. If someone comes to us and say, I own a property, will you manage it for me? The answer is no.
Okay.
So it's not,
so
it's just in-house.
So your view is that you self-manage, or you self-manage indirectly for your clients who you're building a portfolio for, but you don't externally you don't provide a management service to external parties. Okay.
No. But David, if I can come back to my point, in case we are upsetting any people from the lettings business in your audience today, if we take this as an example, calendar monthly income of 475, it's usual that a letting agent will receive 10% per month commission on that, £47.50.
Mm-hmm.
So if something goes wrong and a tenant doesn't pay, it doesn't take long for that letting agent to use £47.50 worth of labor or manpower or cost or petrol to go knock on a door.
Mm-hmm.
So they'll reach a point where they're going to be losing money to manage a property. So for me, it's questionable how motivated they can remain without it being a drain on their business. And that's one of the reasons why it's not their fault, because that's how the industry has evolved over the years. I totally disagree with how they're paid and how it's they're motivated, but we just simply prefer to be right at the sharp end and have a close relationship with the tenants, so we know the little foibles, the little quirks that they all have, and they know us on the other side. So we're trying to build trust with them.
Okay, no, that's interesting, and we'll be talking about courses in a minute. But certainly in a lot of the courses people go to, you'll be told, oh, don't get involved in the letting. You want to make money in property, let someone else do all the letting. You just keep going out and buying property. So you're providing a different take on that. But we'll hold that thought on courses just at the end. So one last question on this. Someone has asked, with this example you've given, did you purchase that 45K cash, or did you then, or was it purchased with finance, or did you then refinance after purchase?
This was a client purchase. It was bought in cash intentionally, and literally there was a day one mortgage application went straight in. So we're not having the numbers to hand, but a lot of the deposit came back out. I think it was financed at 75% loan to value.
Okay.
So, we try wherever possible if a client, if that's their strategy, and we've agreed and we're working together to grow a portfolio, they can leverage their funds time and time over. So they don't need, millions of pounds to build a substantial portfolio. It's all about, if we find the right property, not needing hefty refurbs, and if there's some below market value in there, they can leverage that equity on a lending basis without going silly on the LTV to pull some or occasionally all of their funds out and go again.
Okay, excellent. Okay, so if you want to sort of summarize, we'll talk about courses sort of next as we wrap up. We've got sort of 3 or 4 minutes left here on next session, and allow for any Q&As that come in. So just your take on the sort of the turbulent world, as you say, we're currently in, and the key factors that you think are relevant to your business. Well,
you started off by quoting the word strategy, David. I absolutely agree with that. And part of that strategy, there's an overall strategy, and then there should be an individual strategy for each and every single unit that's acquired for various reasons. But as we go into a changing world at the moment, primarily because of COVID, possibly because there's a recession looming, depending on people's view. We've all conveniently forgotten about Brexit, but that's running in the background. It hasn't been on the news of late because of the presence of COVID. However, there's a lot of uncertainty coming. The nationwide news this morning may have knock-on impacts. We just don't know. So, what I'm really professing is diligence, and more diligence is absolutely key. The reason I'm saying this is that we get, in the Northeast, we get a lot of people who are, I'm going to call them absentee landlords. They're not in the Northeast, but they're buying properties remotely. They really need to have local knowledge, lots of different ways to get that. That's part of what we do, and it stops making expensive mistakes. So all about getting the diligence right. Now, I often say that, and again, I know that, I keep mentioning courses, but the way people tend to evaluate a potential buy-to-let opportunity is to look at the value of the property, and they'll research it on Rightmove or Land Registry. They can do similar diligence on rental values. And this is all taken from historical data. So it's factual. It can be proven. It's verifiable. It's not speculative. It's kind of real. And that's good. But there are at least two. And if you look there, I've put on the last point, buy-to-let due diligence must be 4+ dimensional. We kind of run it somewhere between 9 and 11 dimensions when we're really getting under the skin with clients. Not time to go into all that today, but two of the main ones that often are missed are the tenant, and as we mentioned earlier, where's the rent coming from? Are they in employment? Is it state assisted? There's lots and lots of slants on that can protect the landlord and give maximum opportunity to collect the actual cash flow. And we're passionate about the glue of making all of these various factors work, all of these different dimensions work, is the management. If that's not doing the job, then the deck of cards will fall down at some point, or things will fall off that are going to be expensive to repair, not in a physical sense, but in a financial sense. So it's vital that there is this strategy that encompasses all of these and the other dimensions that we would work to and incorporate. But the last two, the tenanting and the management, are always understated, particularly by landlords that come in, well-intentioned, and think that simple thing of buying a house, putting a tenant in, and watching the money, hit the bank account. It is not like that at all. Okay. So 2 quick questions. We'll grasp the nettle of courses, and then we can wrap up. So someone's asked here, are your clients only doing new purchases within the limited company structure, or still buying in an individual name? So if you have any quick steer on that, or part of strategy at the moment for taxation reasons is most new purchases are being done through a limited company vehicle. Mm-hmm. Okay, perfect. And then, is the rentable demographic you target delivering a far better experience regarding repairs and maintenance, rent arrears, antisocial behaviour, and other typical landlord problems? So is the rentable
demographic you target delivering a far better experience in those areas?
It is, David. Not always. Nothing's perfect, and you will get the odd thing that goes wrong. But that's people and that's property. I think a good point to make is we could find far cheaper properties than we do in real Bronx type areas in the Northeast.
Yeah.
The theoretical rent would be the same, but I'm a great believer in being a realist, and I'd rather be collecting real rent than dreaming of theoretical rent. You'll hear me talking about this a lot. And this again is where people will look at a house value, they look at rent, do their calculation and think the yield is going to drop all the way down to the bottom line or to their bank account. And I'll give you an example in a moment, but it's all about being real and not being greedy on an individual property. They're cheap for a reason. Yeah,
no, that's interesting. As I said on Saturday, my property journey started in 2000. We bought 23 properties in 18 months. In that sort of low end, I think the most expensive property we purchased was 38,000. So that's a lot of that was in that lower end, sort of scale. But then the yields were good. It's a trade-off. Some of my friends wouldn't touch that stock, because of the areas they were in, and it was like, why wouldn't you? Because it just makes sense. But everyone to their own. So let's just nail the courses before we finish them. So I know you have strong opinions, so I'll let you sort of go first, and then John and I can wrap up on the courses. I should maybe put the caveat out, and I'm sure you don't mean every single course.
No.
There are some people out there that do provide good courses and good value. However, what's your take on that arena in the UK currently?
It worries me enormously for two reasons. One, there are a lot of people who are being sold the dream of becoming financially free using property as the vehicle and making it sound as if it's easy and probably more profitable than it actually ever could be. I'm not saying it's always the case. I do know people that have gone on these courses and actually, hit the button and it's really exploded and they've been very, very successful. But that's the minority. I feel sorry for people who go into any form of property strategy, be it buy to let, serviced accommodation, HMO, rent to rent, all the various ones, and get it wrong because it tends to be expensive, and they're not easy to correct either. People then become demotivated and think they failed and walk away. Little example of this is that I work closely with the exec director for housing strategy at City of Sunderland Council, where I live. They've got a real issue. In City of Sunderland alone, there are at the moment 3,300 properties boarded up in the borough. Right. 3,300. When the local authority have analysed that, 70% of them are owned by people from outside of the area that have at some time rented that property.
Interesting.
When I've looked at some of that, and the council, I've asked them for a list and said, look, let's talk to these people, these owners, or let's look at these properties. GDPR doesn't allow, but what we do know is there's a high percentage of these properties are people that have come from courses, come and bought a property, from outside the area. It hasn't worked, management reasons, tenant reasons, Bronx area reasons. So rather than keep trying to correct it or sell the property, it's often easier or cheaper for them just to board it up and forget about it.
Interesting.
Them, but I'm passionate about my home city too. And, it's not great that we kind of get a reputation as being the kicking boys because properties are cheaper here, and someone doing a Rightmove search homes in on that. And a lot of this is focused on by a lot of the courses. I've seen many myself, and they're taught to find deals, for example, Sunderland type deals in the Bronx areas. So, the problem just self-perpetuates and worsens and worsens and worsens. So,
that's very interesting. That's
courses have got their place, and I'm saying there's some real good stuff does come from courses. It's just that particular angle of, making it sound easy.
No, that's fair. No, it's a fair representation. I think it's, you've got to look for the right ones, and of course there's a lot of wrong ones. So Okay, so we're going to have to push on. John, any last things you want to wrap up with Chris on?
No, I think given the time, we need to move forward.
Yeah. Chris, thank you very much for joining us. People can find you on LinkedIn and reach out to you. Maybe at the end, what I'll do is
Thanks,
I'll go back
Chris.
up to your slide where your contact details were, and people can grab that slide if they missed it earlier. So,
Is it also true that there'll be a case study coming up, David?
Yes. Okay. Yep. I was about to say that. So, for those of you who are regulars on our platform, if you go to our homepage, we have not only live deals and deals that were funded. There's also case studies, and Chris has prepared one. We'd hope to have it up today. Circumstances dictated otherwise. So over the next couple of days, you'll see a case study from Chris, and it is Chris's intention to be doing a raise on our platform sometime in the near future.
So independent of the raise, the folks, in the case study itself, once you log into the LEOpropcrowd site, you can post questions in the case study. Look for the forum button, and it'll be specific to the case study that Chris is sharing. And you can post any other questions there if you want to know about his 9 to 11 dimensions and things like that. It'd be a good place to interact with Chris. And it is an FCA authorized disclosure of a case study. So at some level, the details been reviewed.
Yes, and that'll be a really good way to interact directly with Chris as well. So you can look out for that. Just quick update from last week, our Avon Valley Apartments project had sort of funds successfully committed. Obviously now you work through the final completion of the deal, but we actually in 2.5 hours had 27 investors fully fund or fully commit their funds, should I say, to the deal. So that was a great success. So again, where John and I are. Reach out to us if you want to find us. What I'll do is just go back up to Chris's slide. If anyone wants to take Chris's email address, there it is on the slide, and you can grab that quickly before we wrap up. So again, Chris, thank you very much. Really interesting, very, very valuable, and no doubt people will reach out and have a chat to you. We look forward to getting your case study up over the next couple of days. So with that, guys, all the best. Thank you for your time, and look forward to seeing you all again next week. All the best.